Hi, I'm Phil Thompson. Thanks for joining me for Phil's Finance Fix. Today is episode 6 in our Shares versus Property series, and I'll be going into detail about the difference in tax when purchasing, on the income and on the sale of each asset. First up, we'll talk about the tax on purchasing each asset. So with property, the biggest tax is stamp duty. So each state charges a different amount, but for example, Victoria, on a 500k property, you'll pay around $25,000 in stamp duty. While with listed shares, you don't have to pay any stamp duty at all. Income is another big differentiator between property and shares, of which I did touch on a little bit in episode 3. And income from property comes in the form of rent, and rent is just like most income. You calculate how much you receive, minus any deductions, and you pay tax on whatever's left over. While income from shares comes in dividends, which can have some franking credits. So franking credits is basically tax credits, meaning that the income that you receive may have some tax already paid. So how it actually works is Company A makes $100 million in profit in Australia. It's then required to pay company tax of $30 million, and then the remaining $70 million they'll pay out to their shareholders. Meaning that if I'm a shareholder, I own 0.01% of the company, I'll earn $7,000 in fully franked dividends. So when I complete my tax return, the ATO will credit me that $3,000 that Company A has already paid on my behalf. So meaning the ATO is not double dipping on any tax. For example, if I earn $60,000 from work and receive an additional income of $7,000 from rent and $7,000 from fully franked dividends, when I complete my tax return, my after-tax income from the rental property is $4,620 and the after-tax income from the shares is $6,600. So when comparing income from each asset, you need to think about the after-tax income that you receive and not just the dollar amount that goes into your bank account. The third thing to consider when comparing the two assets is capital gains tax. I have done another video that isn't a part of this series explaining what capital gains tax is and how it's calculated, which you can go check out. But basically, when you sell an asset, the gain or the profit that you make from that asset is included in your tax return. Now, both shares and investment property is treated the same for capital gains tax purposes. However, where they do differentiate is if you had a property that you bought for 200k and now you're selling for 700k, you got a gain of 500 grand. So now if you were working and earning $100,000 per year, you'd be up for a capital gains tax bill of around $114,500. And in the best case scenario, if you weren't working, you'd still have a capital gains tax bill of 92 grand. So with shares, it's not an all or nothing scenario. So it gives you the ability to spread the sale over a few years. So let's say you're in the same scenario. You bought shares for 200 grand and now you want to sell it and they're worth 700 grand. So you still got that same $500,000 capital gain. However, because you're in no real hurry, you can spread the sale over 5 years. And if you were earning $100,000, you could save around 17 grand in capital gains tax. And if you weren't working at all, you could save over 50 grand in capital gains tax. And better still, if you could spread the sale over 10 years, you'd pay almost no capital gains tax at all. Thanks heaps for watching, and I hope you can watch next week's episode on the cost of purchasing and holding each investment. If you've got any questions about either property or shares, please feel free to email me, phil@thompsonfs.com.au, or comment below. And if you like these videos and you want them emailed to you directly, you can do this by subscribing to the YouTube channel and then click the cog wheel and click send me updates. So thanks again for watching, and I'll see you next week.